Does your significant other understand asset allocation or expense ratios? How would he or she handle the investments if you were unable to? And should you put your emergency fund in a Roth IRA? We'll answer these questions and more on this, the 115th episode of the DoughRoller Podcast.
Welcome to the DoughRoller Podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Well, good morning, everybody. At least it's good morning while I'm recording this podcast. Believe it or not, I'm still struggling through this cold. I'm almost at the end of it, I think, I hope, I pray. It's been like 2 weeks, but I think I've just about beat this thing. But apologies in advance if I cough in your ear this morning. I will try not to do that. Have what I think is a great show for you, a topic today that is of particular interest to me. I guess I don't record any podcasts that aren't interesting to me, maybe a couple. Anyway, this one is of particular interest to me, and it's what my wife, how would she handle our investments if, yeah, that's right, I got hit by a truck. If you've listened long enough, you know that's my way of dealing with death. If I get hit by a truck, how would my wife handle our investments? Last night we were watching a rerun of Law and Order. Yes, we live in a very exciting lives. And in a commercial, I turned to her and I said, so, if I got hit by a truck, and then of course she rolled her eyes at that point, but I kept going, how would you handle our investments? Now at this point, I know you're thinking, poor lady, how has she managed to put up with me for more than 26 years now? I don't know. She's a saint. That's all I can say. And she just shrugged and said, well, I guess I wouldn't do anything with them. I'm like, what? You wouldn't rebalance? She's like, So that got me focused on this topic today. I'm going to guess that most of you listening to this are the spouse that handles, if you're married or if you have a significant other, you're the one that handles the investments. Maybe there are some of you listening, you're not the one that handles the investments, but I'm going to guess most of you are. And I'm going to guess that a lot of you have kind of the same concern. If something were to happen to you, would your significant other know what to do with all of your accounts, your investments? And so that's really the main topic of today's show. I'm going to give you some ideas on some ways to deal with that. Preferably before you get hit by a truck, by the way, because, after you get hit by a truck, it's too late. So that's the main topic of today's show. So that's what we're going to do today. Before I get to that, I have a question from a listener named Thomas, a very good question. And let me read you the email. He wrote in, he said, I was wondering what you thought about using Roth IRAs for storing emergency or savings funds. My wife and I are both 40 years old and keep about 2 months emergency fund in a savings and CD account. And the rest we are putting into Roth IRAs, one for my wife and one for me. 75% of the asset allocation is in Vanguard short-term bonds, and the other Vanguard 25% is in stock funds. Additionally, we are also building our down payment for our next house in these accounts. If something happened with the market that hit the stocks hard, we would have no problem putting off our move. When we do move, our current house will be paid off, and we will be renting it out. We currently don't have money that could be directed to the Roth IRA otherwise, so we would not contribute to the Roth IRA otherwise. Thank you for all your information and help. I've really enjoyed listening to your podcast and reading your blog. Well, that's a great question. First of all, I guess congratulations to Thomas and his wife. I mean, they're just hitting it out of the park. They're at 40. They've got a house that's paid off. They're thinking about these issues. They're about to move at some point in the not-too-distant future into a second home, rent out their first home. Excuse me. There I go, my cough again. They're doing terrific. So the question is, should they use the Roth IRA to either save for emergencies and also perhaps to save for this new house that they want to buy? So I have a couple of thoughts on that. Actually, I have 7 thoughts. So here we go. 1. First, the Roth IRA is a viable option. Why? Because if you've listened to previous podcasts, you know you can withdraw the contributions to a Roth IRA without paying tax or penalty at any time. So you contribute money to a Roth IRA, if an emergency were to come up, or you wanted the money to buy a home or anything else for that matter, it doesn't matter why you want it, you can distribute the contributions that you've already made to the Roth IRA. So for that reason alone, a Roth IRA is a viable option. That's point one. Number two, the other thing I like about it is if you're contributing to a Roth IRA, for whatever reason, maybe you're saving for emergency, saving for a house, or just, you're not even sure yet. Maybe it's retirement, you're not quite sure, but you've started contributing to a Roth IRA. You should know, if you've been listening to the previous podcast, that starts the 5-year clock ticking as the 5-year rule as it applies to contributions, right? And unlike the 5-year rule that applies to conversions, the 5-year rule that applies to contributions, once you've met it, you've met it. You're done. You've met it for any and all future contributions. It's been satisfied. And so even if you start out thinking of your Roth IRA as an emergency fund, the fact that you've started to contribute to it gets that 5-year clock started. Okay, number three, and this is a potential, I think, downside to using the Roth IRA, and I call it the investing choice conflict. And here's what I mean. If you're saving for an emergency fund or a house that you're going to buy in a few years, you're generally investing that money very conservatively, right? You don't want to put it in 100% stocks generally because of potential market fluctuations. And in fact, that's what Thomas has done. 75% in short-term bonds and only 25% in stocks. So that's a very or fairly conservative asset allocation. Now, that's fine perhaps for an emergency fund. Actually, some might say you want 100% in short-term bonds or savings CDs, but still relatively conservative. That might be okay for an emergency fund or to buy a home, as Thomas mentioned. If the stock market were to go down, they'd be fine waiting on the home. So that's all good, but not so good for long-term retirement investment, right? Now, he says 40. So if we don't know all the details of their situation, but assuming they were going to retire at a traditional age of 65, that's probably, for most people, too conservative. And so you have to kind of decide, what's this money for? Is it for an emergency fund in which I'm going to invest it conservatively, or is it for retirement in which I need to be a little more aggressive, perhaps? And that kind of raises a related question with this approach. If you're going to use the Roth IRA for short-term spending, emergencies, a house, what have you, what are you saving for retirement? And where's that money going? Now, it may be that they have 401ks at their work and they're maxing out their 401ks, and that's enough of savings for retirement. But these are things that you need to think about when you consider using a Roth IRA as an emergency fund or a savings account. I think what some people do is say, look, I'm going to go ahead and put the money in a Roth IRA for retirement, but I'm not going to have a huge emergency fund in a low-paying or low-yielding savings account or CD, because I know if push comes to shove, I can withdraw my contributions from the Roth IRA. I'll fall back on that if I have to. So in that sense, they're sort of erring on the side of, hey, this is really for retirement, and I'm going to invest it as if it's for retirement. At the same time, I take some comfort in knowing I can pull some of that money out, my contributions, if I absolutely had to. I think that's a fine approach too. You do have to realize, though, again, as Thomas pointed out, if you have a lot of it in stocks, fine for retirement, but you could have an emergency at a time when the stock market is down 40% and find yourself pulling money out at the absolute worst time. So that's something that you need to consider and think about. But it all comes down to this sort of conflict between short-term savings and spending versus long-term investing, and doing those things in the same account. So I don't think there's any one right answer to that, but it's something that I think you ought to think about if you're considering this approach. By the way, you can open a Roth IRA at a bank. You can go to Ally Bank, just an example, an online bank. They have Roth, savings accounts and IRA and CDs. So, you don't have to invest in the stock market inside of an IRA. You can have very, very conservative investments. But again, from a retirement savings perspective, probably not the smartest move for most people, because the returns are just, not enough. You're not going to, getting a current yield of about 90 basis points or 90 bips, as they say in the industry, on a savings account, might be fine for an emergency fund, not so good for long-term retirement savings. So it's just a conflict there that you have to think about, think through, when you're considering using a Roth IRA for shorter term savings. Fourth thing, and this is something that Thomas pointed out, but remember there's obviously contribution limits for IRAs. Now, if you're married, you can each potentially contribute to a Roth IRA, and so that's good, doubles your contribution amount. And of course, if you're 50 or older, you get an extra $1,000 that you can put in, and these numbers can adjust from year to year. But there is a limit to how much you can put in an IRA, so that you need to kind of factor that in to your planning. The fifth thing is, I think this requires a lot of discipline. I prefer, for me, to think of my retirement accounts as accounts that I will never touch until retirement. Just hands off, never going to touch them. If you're already kind of going into a Roth IRA thinking, well, I'll use this if an emergency comes up, I think it requires a lot of discipline to truly only touch it if it's, a real emergency, right? And, probably going on that cruise, well, I don't know. I shouldn't be judgmental. Maybe that's an emergency for you. It's not an emergency for me. But the point is, if you're going to kind of use this Roth IRA is for multiple purposes, and you really need to be disciplined and be honest with yourself as to why you're considering, say, taking out some of the money if you come to that point. You really need to be disciplined, or it's going to hurt you in the long term. Number 6, remember there are income limits. If you make too much, you can't contribute to a Roth IRA. So that's something to keep in mind. And by the way, what I will do, what I'm talking about here will actually not be in the show notes. This section of the podcast I will publish as a standalone article on the blog, and I will have links. I'll have links to the IRA contribution limits. You may know what they are, but I'll have links to that. I'll have links to the Roth IRA income limits, so you can check that out. You'll find that on the blog, on the homepage when this podcast is published. Also, if you subscribe to the newsletter, which you can do easily, DoughRoller.net/newsletter, I'll link to it in the newsletter. But there are income limits for Roth IRAs, and that brings me to the related point 7, and that is this doesn't work with conversions. At least it doesn't work quite so well. Remember, if you've listened to the 2 podcasts on the 5-year rule, with conversions, if you're not 59 and a half or otherwise able to take a qualified distribution, when you convert the money, it has to stay in the account for 5 years to avoid the 10% penalty, right? So if you converted money into Roth IRA and then had an emergency 6 months later, if you took the money out, you'd get hit with that 10%, or you may get hit with that 10% penalty. So that's something to keep in mind. So, at the end of the day, yes, a Roth IRA I think can be used for short-term savings, and maybe it's a good way to kind of get started with the Roth IRA and maybe not putting as much money in a savings account for emergencies. But again, as I've gone through this list, there are a number of different things to consider, including how you're going to invest the money, and how, and just being disciplined on how you use it. I think that's very important. So yes, it's a viable option. It does have some issues that you ought to think through before going down that path. Okay, Thomas, thanks so much for the email and the question. Great question. And for those listening, if you have questions or topics, well, you can email me, dr@DoughRoller.net. Okay, on to the main topic, the hit by a truck topic. I get hit by a truck. What in the world is my wife going to do with our investment? So what I've decided to do, and I'm actually working on it now, is to put together what I hope is a very short document. My goal is to keep it to no more than 2 pages that I can share with my wife now, and I can maybe over a cup of coffee, walk her through this 2-page document that I hope will give her everything she needs to handle our investments. And what I'm going to do in this podcast is walk through primarily the 6 main items that I plan to have on this list. Now, every situation is different. You may need more. You may need fewer. So, I've got a number of things I'm going to walk through. I kind of think for most people, this would probably be a minimum of what you need, but every situation is different. Yours might be far more complicated than mine. So let's walk through them. The first one is identify all the accounts. My wife doesn't know all the accounts we have. It's not because I'm keeping them from her. But if I were to ask her, tell me where we have all our bank accounts and investment accounts, she wouldn't know them all. She would know some of them. She'd probably know the important ones. But she wouldn't know them all, or wouldn't be confident that she knows them all. And so the very first part of this document is going to literally be a list. Vanguard, Fidelity, Citibank, Capital One 360, Lending Club, Prosper, Options Express, Chase. Walk through all of them with a kind of a short description of what's there. Fidelity, that's my 401k retirement plan from work, right? Chase has the checking account that I have with my good friend and business partner that I own real estate with, right? So I'm going to kind of just walk through at a high level every account that we have, so she knows what we have and where it is. So that's the first thing. And I can tell you, having handled my stepmother's estate, of course, it's different, I think, when you're handling the estate of a parent. But when in handling her estate, she had a list. So knowing that I wasn't missing anything was a great comfort. And so that's really the point of this first of sort of 6 sections that I'm going to walk through. Identify all the accounts. It's a simple thing. It won't take you very long unless, I guess some of you maybe have hundreds of accounts. I don't know. But for me, it doesn't take that long. I think for most of us it won't. But boy, it'll be a big help. They won't have to worry about it. You'll know that they know where everything is, and they'll have comfort that they're not missing anything. Simple step, but an important one. So list all the accounts. And by the way, you could even put this in a bit of like a binder. And after this 1 or 2 page document, have the most recent statements from each of these accounts. You don't have to update it monthly. You could probably even do just a sort of a year-end statement, but that would kind of show them, a fairly recent balance and the account numbers, contact information, and so on. So you could just, layer that behind this 2 page document. So that's the first thing. Identify all the accounts. Number 2, life insurance. And there's a couple of things here. Well, the first is just making sure they know that, here's the life insurance, here's the policy number, here's who it's with. And I would get very specific. Here's the phone number you call, and here's the address. Here's all the information you need. So if I get hit by a truck, you can make sure that they know where the life insurance is and how to submit the claim and get paid. Now, that's the first thing. I think there are a couple of other things about life insurance that I know I will cover in this document that I am creating. The first is what bills should they pay with the proceeds? Now, at one level you could say, well, your spouse will figure that out, and yes, they will. But I do think it's worth talking through some of these issues in advance. The biggest one, I think, for most people, certainly for us, is should my wife pay off the mortgage with the life insurance proceeds? Now, it's interesting. I just did a podcast on this topic where someone inherited money, and the question was, should they use the money to pay off the mortgage, or should they use the money to invest, right? And that was podcast. I know I'm going to get this wrong, but I'm pretty sure it was podcast 108. But let me just look that up real quickly. Yes, podcast 108. So in this situation, what I will likely suggest to my wife, of course, it'll be her decision, but what I will likely suggest to my wife is that she go ahead and pay off the mortgage with the insurance proceeds. I think it'll be one less thing she has to worry about, and then she'll have plenty of money left over to take care of herself and our children. And so that would be my suggestion. Of course, obviously the decision will be hers, but I think it's going to be hard enough if, particularly if someone dies relatively young, your spouse is going to be dealing with all of the emotions of that issue and the children. And I think it can be a great comfort to them if you think through these issues ahead of time and make the decisions ahead of time. Again, not that they can't change that decision. Of course they can. But it's just one less thing that they have to deal with and worry about. So that would be my suggestion. That will be my suggestion to her. Pay off the mortgage with the insurance proceeds. You may have other, expenses. You may have school loans and car loans and other things you want to think through. For us, it's just the mortgage. But I think that's something that would be helpful to think through in advance. The second thing is, how are you going to invest what's left? Presumably there's going to be proceeds from the insurance policy after expenses are paid, hopefully. And then the question is, well, how do you invest that? Now, we're going to talk about that in more detail, but this kind of struck me when I was talking to my wife last night, and I bombarded her in the middle of a commercial with a ridiculous question, how's she going to invest our money? If I get hit by a truck, and she said, well, I'm not going to do anything, I'm going to leave it alone. And later I was thinking, well, that may work for our current investments, but it's not going to work with the life insurance. She's going to have a decision to make. There's going to be some cash. What are you going to do with it? And so that's got to be part of, I think, the analysis. I'm going to come to that in more detail in just a minute. But for, I think, a lot of families, life insurance will generate proceeds that will need to be invested. The third thing is, I think this is in part a discussion to be had with your significant other, more so than something you put in a document per se. But it's this: are they going to invest on their own, or are they going to get help? And I can tell you that in my wife's case, she'll get help. She won't want to do it on her own, and that's fine. But that may not be the case for your significant other. And I think it's something that ought to be thought about now, not later. Not after the truck. It should be before the truck. And that's a big question. And it kind of leads to points 4 and 5. So, you've got to think about, point 3 is think through this issue. Do it yourself, or do you get help? And that takes some thought. And then based on your answer, I think it kind of leads us to 4 and 5. 4 is decide now who they will get help from. If they're not going to be a do-it-yourself investor, if they're going to get help, I think it's good now to give them some ideas as to where they can get that help. And there's a couple of reasons for that. First of all, for the spouse that handles the investments, they take my example, my case. I understand investment fees. I understand the investment advisory world. I understand the impact fees have on returns. My wife doesn't. I mean, she's certainly capable of understanding that. It's just not something that's interested her. So she can benefit from what I've learned over the years in picking an advisor, right? That's the first thing. The second thing is, again, it's kind of like paying off the mortgage. It's good to have some of these decisions made ahead of time because, after the fact, the emotion, all the things you're dealing with, I'd rather have my wife make the decision now when she's not dealing with all those other things than to wait until then. So, decide now who they're going to get help from. I can tell you in our case, what I'll recommend to my wife is to use Vanguard. They have investment advisors, depending on your account size. I think I've mentioned they're 30 basis points, so it is an added cost, but I think in my wife's case, it'll be money well spent. I trust them. It's low cost. I'm not going to pay 1% or more to an investment advisor that I don't know. So that's going to be my advice to her. In your case, you may have an investment advisor, and the decision's kind of easy. She or he will just stick with who you're using now, right? A third option, again, could be a robo-advisor. Maybe they're comfortable it's sort of a hybrid of do-it-yourself and getting help, right? Using a Wealthfront or a Betterment or a Personal Capital. So that sort of thing. But I think, again, it's not so much that there's one right answer, but deciding now who they will get help from. So in my case, in this document, I'm going to put in there, Vanguard advisors, here's how much they cost, here's the phone number of who you contact. Most of our investments are already at Vanguard, so that makes it easy. And so it's just a phone call and to get started. So that will be in this 2-page document that I'm preparing. So that's for folks that, their significant other, you think they're going to want to get help. For those that want to do it themselves, then I think you need a little more information. And so this is point 5. It's putting together a very simple, easy to follow investment plan. Now, I will put this together for my wife anyway, even though I think she will use Vanguard advisors. I'm going to put this section together for her anyway, because I think it'll be helpful to her. And who knows? I mean, life is a funny thing. I mean, the day could come when she decides to invest some of this on her own. And I'd like to be able to have some input into how she does it. Now, some thoughts on an investment plan. Investment plan sounds like this big thing, and it's bound 100-page document. No, an investment plan can be half a page. Okay, and in fact, for the significant other that doesn't like investing, the first thing I think you need to watch for is information overload. I can tell you now, I may like to think about whether commodity funds should be part of an asset allocation. I can assure you, my wife has no interest in that topic at all. Could she understand expense ratios? Of course she could, but she has no interest in them. She doesn't know what's reasonable. If I told her 50 basis points versus 150, well, first of all, she might not know what a basis point is. That's okay. but you get the point. They're not going to have the patience for or want to learn a lot of the stuff that maybe you and I are interested in, and that's okay. They certainly would be capable of it, but they're just not. They don't have that interest. So, the first thing that I think we need to be careful with is information overload. So, with that in mind, I would do a couple of things. One, I would be very, very specific with the investments. So, in other words, I wouldn't go through some high-level asset allocation theory and all this sort of thing. I'd just say, here's the mutual funds, the specific funds, let's say at Vanguard or wherever you have your accounts, that I think should make up your investments. And it could be a single investment. It could be a target date retirement fund at Vanguard or Fidelity or wherever. One fund. That might be the easiest way, particularly for folks that don't really have any interest in learning all of the nuances of investments. Here you go. And it might be that you've got 10 different funds now, because that's how you like to handle your asset allocation. But you could tell your spouse, look, if I get hit by a truck, this single retirement fund, target date retirement fund is fine. Take all the retirement accounts and consolidate it into this fund, right? Or you could use a 3-fund plan, which usually involves like an S&P 500, a bond fund, and an international fund, right? So 3 funds, pretty simple. Or 5 funds, you'd add to those 3, in my view, REITs and emerging markets. A perfectly good, I think, asset allocation plan, but being very, very specific. Now, the fourth thing, and this is probably the one area where I'd get into a little more detail. We've talked about target retirement funds, a 3-fund plan, a 5-fund plan. The fourth thing is risk tolerance. I want my wife to understand that whether it's because she works with Vanguard advisors or does it on her own or works with someone else, if she's in a portfolio with 80% equities, 20% bonds, or 70-30, she needs to be prepared for the portfolio to lose 30 or 40% in a year, about once every decade or so, or whatever, once every 15 years, whatever it turns out to be. She needs to understand that's normal. Don't freak out when that happens. Now, again, for this reason alone, it's probably another reason why I would lean towards, in her case, using Vanguard advisors so they can help educate her about these things. Because, she knows, my wife knows what our balances are when I tell her. I mean, she's just not interested. It's just who she is. I love it about her, actually, but it's just not her thing. And so if she were now handling this on her own, and all of a sudden, after 6 months or a year, the account was down by 25%, I'm not sure how she'd handle that. I mean, the other thing is she might think it's her fault. Boy, if Rob were here, this wouldn't happen, which of course isn't true. So I'm trying to think about all these, not just the numbers, it's not just asset allocation, it's the psychological issues and all of these factors. So I would, in the investment plan, talk about risk tolerance, basically saying, look, these kinds of down markets are normal. Don't think of these things as abnormal, particularly if you're in a passively managed index portfolio. So in those 4 ways, I would be very specific in the investment plan. Now, there's a couple other things to talk about. So we talked about information overload. We talked about being specific, right? And I gave you 4 examples: target retirement fund, 3-fund plan, 5-fund plan, and then risk tolerance. Okay. The next thing under investment plans is individual stocks. If you own individual stocks, as I do, as my wife and I do, you need to have a plan. And this is particularly true because my wife's not going to have any idea what to do with those individual stocks. Now, the plan could be, if I die, sell them and roll them into, the plan you're going to use with a Vanguard and advisors, or the plan you're going to use if you do it yourself. Yes, if it's in a taxable account, there may be some taxes, but that may be the best option for you as a way for your significant other to handle those investments. I suppose another approach would be just to leave them alone. That, as you might imagine, that concerns me a little bit, even with the kinds of stocks that I invest in, which are large U.S. companies that I don't expect. If any stocks, if any companies are out there where you could just buy them and leave them alone, it's the companies that I own, like Berkshire and Wells Fargo and Ford, and whatever. But that kind of gets a little gets you a little nervous. Because things do happen, so that is a possible approach. That one makes me a little skittish, but the real point here is if you own individual stocks, you need a plan on how your significant other is going to deal with those stocks. I think in our case, I would tell my wife that eventually they need to get rolled over into the other investments. Excuse me. I don't think it's an emergency. I don't think it has to happen immediately. But that's going to be probably the best approach, given the fact that I know she's not going to want to manage those individual stock investments. All right, the last thing I want to talk about on the investment plan is really important. And it's something that I overlooked as I was going through sort of the first draft of this podcast and the first draft of my document to my wife, and it's this, the need for current income. So right now, we don't draw any income from our investments. We reinvest dividends, we reinvest interest, we reinvest any capital gains that are distributed in these mutual funds. We don't take anything out. If I were to get hit by a truck, my wife would have to immediately start using some of this as income. I mean, she does work part-time for a charity. It's an adoption agency. Even if she paid off the mortgage, though, that charitable work would not generate enough income to take care of herself and our children. She would need to pull some income from these investments. And so as I think about the best plan for her, I'm going to need to rethink, how I invest this, how she'll ultimately invest this money. Because it will need to be invested in such a way that she can take a certain amount of income from these investments, which may mean a slightly more conservative asset allocation, maybe, or it could just mean a slightly different investment options on the bond side. I haven't thought through that completely, but it's something to consider because, a lot of significant others will need immediate income. One of the things that I'm going to do in that section of the document that I am preparing for her is to say, look, you can generally only take X percent from an investment portfolio. If you take more than that, particularly given that we're relatively young, you're likely to run out of money sometime in retirement. Now, you've probably heard the 4% rule. That's for people retiring, and there's some debate about it. I think it's probably a fair number to use for planning. But I think for my wife, I'm going to try to get that lower. I'm going to suggest 2 to 3%, in part because she's much younger. We're not at retirement age yet. And I think those percentages will give her enough money anyway, to live similar lifestyles that we live now, such as it is. But again, putting the details aside, they're going to vary from person to person, family to family. As you think about this overall investment plan, as you think about information overload, about being specific with the investments, about dealing with individual stocks if you own them, don't forget the fact that they may need to take immediate income year to year. That needs to be thought through and factored in to the plan. The last thing I will mention in this sort of investment plan topic, this won't apply probably to many of you, but it applies to me, and that is I own real estate with my a longtime friend and business partner, and so I'm going to need to have a section in there for her on what to do with that real estate. Now, again, it's helpful that I have a business partner that I trust, and so the plan will basically be give Mike a call. That's what the plan's going to be. But if you have other alternative investments like real estate, you may need a whole separate document on how to deal with that. Think about it. If you're managing 5 properties, does your significant other even know the addresses? Do they know the names of the tenants? Do they know where checks get mailed each month, or if it's electronic? Do they know when the leases are going to expire and how to rent out the property? I mean, again, depends on, every situation is different. Obviously, folks can figure this stuff out, but I think the more information you give them now, the better they will be when they have to deal with this. Hopefully they won't, right? But I mean, if again, get hit by a truck, they'll be able to handle it. So again, in my case, it's somewhat easier because I can just say, give Mike a call, but you may need, Mike's my good friend and business partner, if you hadn't figured that out. Anyway, you'll need some additional information with these sort of alternative investments. Another alternative investment, by the way, that you might have are coins, right, and stamps. Will they know the value of them? Will they know where they can sell them or what they should do with them? That could be a whole other document depending on your circumstances. So obviously, I can't in this podcast address every potential circumstance. It's sort of like a high-level overview and things for you to think about. But when it comes to alternative investments, you'll need to think about what additional information your significant other might need. Okay, the sixth and final thing, retirement accounts. So I have 401ks. Of course, they're in my name, right? All retirement accounts are in individual names. So my retirement account is not a joint account. It's in my name, 401ks. And then I have an inherited IRA from my stepmother. I have a rollover IRA. I have a very small Roth IRA. I have a SEP IRA. What in the world is my wife going to do with all these? And at this point, I'm not talking about the investment part of it. We kind of covered that. In my case, give Vanguard a call. But what do we do with these retirement accounts? The 401k, for example. Does she leave it where it is? Does she roll it over into an IRA? How does it get titled? Should she consolidate all of these into one IRA? Make it easy? What should she do? Now, again, excuse me, I think in this document, what will be helpful and what I'm going to do is be very, very specific. So it'll be, okay, I have this 401k. Here's what I suggest you do with it. I have this IRA. Here's what I suggest you do with it. Now, at a high level, this could be a whole podcast episode. In fact, I'll cover this. But let me just deal with it very generally now. When you're dealing with a spouse, when you inherit an IRA as a spouse, so in other words, your husband or wife has passed away, they had an IRA or a 401k, but we'll deal with an IRA, and you were the beneficiary. So what happens with it? Well, you can treat that as what's called an inherited IRA, or you can have it retitled and make it your own. So you're now the name on the account, and it's treated just like your IRA. What are the advantages and disadvantages? Well, the advantage of an inherited IRA, treating it as an inherited IRA, is that you can withdraw money from it before you're 59 and a half without paying the 10% penalty. And in fact, in an inherited IRA, you have to begin taking distributions. There's a couple ways you can do it. There's sort of a 5-year plan where you take it out over 5 years, or you can stretch it out over based on your life expectancy, which is what I've done with my stepmother's inherited IRA. Now, again, she wasn't my spouse, so I don't have the same choices that a spouse has. I had to take it as an inherited IRA, and I've spread it out the required distributions over my life expected life. So it reduces the amount I have to take out each year, which of course generates taxes. So I wanted the smallest amount. So it's over my expected lifespan. But if you're a spouse, you can do that. And again, the advantage is you can avoid the 10% penalty. The disadvantage is you have to start withdrawing money immediately, and it will be taxable, right? If you title it as your own IRA in your own name, the good news there is you don't have to start taking required minimum distributions until you're 70 and a half, just like as if it were your own IRA. That's the good news. The bad news is if you do need some of the money out of there before you're 59 and a half, you could end up paying that 10% penalty. It's treated just like it was your IRA. So again, that's just a very quick, high-level overview of that. If you're in that situation, you're going to want to get specific advice. Don't just rely on this podcast, please. So, call your Fidelity or Vanguard or where the 401k is. They will walk you through all of this. But back to this plan, what I'm doing is for every single retirement account, I'm going to be very, very specific. This is the 401k. Roll it over into an IRA at Vanguard. Retitle it as your own, because I don't think she'll need to withdraw money from it before she's 59 and a half. And I'll talk her through this. Again, this is not just me saying, go do this. This is going to be a conversation. And she may have a different view on it. I haven't talked to her about this. She may say, Rob, you've got it all wrong, and this is how I'm going to do it. And that's fine. But that's really the whole point, is to invoke these conversations and think about these issues now. But I think what will make the most sense is roll it over to an IRA, retitled in her own name for the 401ks and the IRAs. I don't think she'll have any need to withdraw from those funds. She's 50 now, so in the next 9.5 years, if I were to get hit by a truck today, God forbid, But the point is, you got to think about these retirement accounts and what your significant other will do with them. And again, I think it's helpful to be very, very specific. And I would even say to her, when you want to do all of this, here's the number at Vanguard that you call. Call Vanguard. Yes, the 401ks are at Fidelity. Don't call Fidelity. Call Vanguard. They will initiate the process, and they will walk you through it and make sure you're doing it right. They will discuss with you inherited versus retitling it in your name. The rules can change. Maybe, if it's a year from now, maybe the rules are different. So, but again, I think for this document, walking through each of the retirement accounts and what she should do with them. And then, of course, once I have the document done, again, I'm going to try to limit it to 2 pages. I'll go buy her a cup of coffee at our favorite coffee shop, and we'll walk through it. And she'll, agree, disagree, we'll change it, whatever she wants. But she should have sort of a blueprint to walk through to handle everything from, the life insurance all the way through to retirement accounts. So that's the plan. That's what we're doing. And I think it should give her a pretty clear, path and understanding of what to do, if she had to take over all of these investments on her own. So that's my plan. If I've missed something, you think I should add something, you've got some other tips in this regard, maybe, and I hadn't thought about this as I started this podcast, maybe, you have lost a spouse and you're now in the position of managing your own investments. So maybe you've seen this firsthand. Every situation is different, but, if you have tips, suggestions, tools, resources, something I've missed, would love to hear from you and your experience in handling this. Because it's the kind of thing we don't like to think about. At least I don't like to think about it, but it's important, and it's important to think about before you need to. So if you have any other thoughts on it, please email me, dr@DoughRoller.net. Would love to hear from you. Okay, on to the tip of the day, and this one's kind of different. It's a website, and it's the web address is easy. It's IFA.com. It stands for Index Fund Advisors. Index Fund Advisors, it's an investment advisory firm. They can manage your money for you if you want. I don't have any relationship with them. I don't know anyone that works there. I've never spoken to anyone there. So why in the world am I suggesting you go to IFA.com? They have some really interesting and cool charts. If you go to the homepage and scroll down, and I'm doing that now, you will see a number of charts, actually. The very first one they will show you is sort of a scatter plot, I guess that's what it's called, of different asset allocations from all the way from 5% equities, 95% bonds, up to 100% equities. And it shows you the growth of $1, the annualized returns, and the annualized standard deviation since January 1, 1964 to the present. And you can see how as you increase the amount of equities you have in a portfolio, all those things go up. The growth of $1 goes up, the annualized return goes up, but the annualized standard deviation goes up. And if statistics ain't your thing, think of it just as how much the returns fluctuate, for the better and for the worst. So the higher the standard deviation, the more the returns will fluctuate from year to year. So for example, with 5% equities, $1 from 1964 grew to $16.75, had an annualized return of 5.72%, and an annualized standard deviation of 3.08%. Very, very stable investments, as you might expect. Go to 100% equities, and $1, instead of growing just a little bit, grows all the way to over $500, annualized return of over 13%, but annualized standard deviation of over 16%. I think this is a cool chart. In addition to that, they plot different investments. Like they have an emerging market fund that would have grown, $1 would have grown to over 3,000 and had an annualized return of 17.23%, but an annualized standard deviation of 21.35%. That is a huge standard deviation. That basically means, and this is true of emerging markets, you might lose 60 or 70% in a year. Believe it or not. I mean, it can have huge swings. Anyway, I think this is a pretty cool chart. Just to gives you an idea of how the different asset allocations can affect your risk and your reward. And that's just one chart. You'll see to the right, they have a whole bunch of charts that you can check out. They're interactive. They're quite good. And I think just a lot of fun to check out and kind of see how different portfolios stack up and the returns over a period of time. And so that's the tip of the day, IFA.com. I think it's a pretty interesting website to check out. Well, there you go. Hope you have a great day. As always, any questions or topics you want me to cover, anything, if you have tips or tools or resources, I love to hear from folks about that. I'm kind of a collector of personal finance tools and resources and calculate. I love calculators. You come across a good calculator, online calculator, shoot me an email. I love those things. So love to hear from you, dr@DoughRoller.net. And if you haven't subscribed to the newsletter, DoughRoller.net/newsletter, would love to have you join. It goes out once every Saturday. I don't spam you. I don't sell the emails to anyone. You can easily unsubscribe. But why would you? I don't think you would. Anyway, but you can if you want to. So that's DoughRoller.net/newsletter. And if you haven't subscribed to this podcast, head over to iTunes and subscribe. I would greatly appreciate it. Hey, hope you have a great day. Until next time, remember, the best thing money can buy, it's financial freedom.